It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today, Michael Becker.
Hey, Paul.
Smartest guy I know. So Michael, who owns 4,600 doors in the Dallas-Fort Worth area, has hundreds of investors with him buying multifamily properties. He's done a great job and up to his eyeballs in non-recourse debt.
That's right.
So today on the Ask Mike Monday, there was a question that came up, which I thought was a great question, is that like many investors in my position, I'm using a fully amortizing bank loans or private money interest-only loans. Obviously, interest-only multifamily loans are a unique beast. I love a short blurb on situations where IO, interest-only, is a reasonable to ask, and any ideas related to that. Is it value-added only? Is it acceptable to simply say it helps us hit our equity return goals? So, Mike, let's talk about interest only. What do you think?
Yeah, it's certainly something that helps juice the cash-on-cash returns out of the gate. And in a lot of cases, when you're doing a reposition of a property, it's almost a necessity when you go in these kind of broken properties. And as Paul likes to say, doing the Humpty Dumpty loans, kind of put Humpty Dumpty back together. And when you're doing that process, you have lesser cash flow because you're going into a broken situation. You usually have to take your occupancy down a little bit before you make it better and kind of clean the place up. So certainly having interest only on a renovation is pretty much is very typical on these kind of bridge loans. So that's one. And then on the stabilized deals with the Fannie and the Freddie is certainly pretty common in today's marketplace to have at least 1 year of interest only, if not multiple years of interest only on the front of these deals. To the question, I don't think it'd be well received by your banker if you say, hey, I need this IO to hit my return projections. Your banker doesn't necessarily care about that.
They don't want to hear that.
Yeah, I wouldn't use that tactic when you're requesting IO.
So how would you phrase it, Mike? How would you get them to play ball with you as interest only? What would you say?
The multifamily space is two basic avenues you go down. You kind of have your traditional bank, community bank type financing, then you have your agency, your Fannie and Freddie. And in the Fannie and the Freddie, it's just really a competitive thing more than anything that these other, the DUS lenders, the delegated underwriting servicers on the Fannie side of the Freddie lenders as well, which is kind of a competitive thing that anymore they're so-and-so their competitors doing it. So if I want to win the business and I need to do it, then, that's kind of a slippery slope from Paul and my perspective, kind of putting our banker hats on, having too much IO is kind of the gasoline on the fire is making some of these deals. The pricing of these deals go up because these deals have such longer IO periods. They're making the returns go up. But, from a borrower's perspective, it's certainly an attractive thing to have some interest-only thing on these properties. The cautionary tale, I'm sure Paul will talk about, is just, trying to be over-levered and putting the IO on it and buying in questionable locations and not putting your renovations. Those are kind of the telltale signs of things that could cause some problems in the future. It's kind of just structurally the way you set your deal up. But, back to the question, really, the interest only is more of anymore now. If it's a stabilized type asset, it's more of a competitive thing in the marketplace. And then if you go into community bank, you like a good commercial mortgage broker like we are, we kind of know the shops that are out there that provide the better financing terms. So they're going to do it. Or if you're doing it yourself on a small deal, you get a couple quotes and then, one quote has it. You can go to the other one and kind of play them off each other a little bit.
Yeah, typically banks do not like to do interest only just because the regulators don't like to do interest only unless it's, a short term, maybe 6 months or 12 months that they'll take a look at it. If it goes anything farther than, say, 24 months, it becomes like a non-performing asset. So the bank has to put more capital aside and they have to recognize that it could be possibly a problem asset down the road. So with, interest only, bankers don't typically like it.
Meaning the community banks, right?
In the community banks. Yeah. So typically things that we would say is it's not to juice the rate of returns for my investors, but to give some better cash flow on the property so we can definitely pay you back faster, maybe a way of handling it. We don't want to show that we're only into this to make a rate of return on our money. We want to improve the property. We want to get better cash flow and you're probably going to get medium-sized leverage on the deal. Typically, with interest only, you don't want to go high leverage at 80%. It's usually 70 or 75% on a bank transaction.
Yeah, that's very typical. The community bank mentality is really, you have IO for a purpose. If the property is being repositioned and cleaned up, that's typically the answer. On the agency side, it's different. It's just a competitive thing in the marketplace, and 1 year IO is pretty much a given. And then above that, it's pretty common to see multiple years of interest only.
Yeah, 2, 3, and then sometimes up to 5 years IO. And again, we just don't like the 5 years IO. We think that's gasoline.
With the full leverage.
With the full leverage. If it's a 55 or 60% leverage, yeah, we don't have a problem with that. The lower leverage, being an old loan dog, I just don't like to see high leverage with high long-term interest only. That's just my personal opinion. So
he's got a lot of them.
that's why I've done this for a long period of time. So, Michael, what's going on the Old Capital podcast?
Yeah, so if you guys certainly, first off, if you appreciate the information, rating and review on iTunes, Stitcher, SoundCloud, one of those podcast sites is certainly appreciated. It helps attract better guests and gets us a little bit more visibility. I mean, if you guys want some basic information about how these transactions get put together, www.oldcapitalpodcast.com, and you have a 15-page white paper, kind of multifamily financing 101, as well as a sample due diligence checklist. So if you're putting an LOI in on a property, you can kind of use that information on the type of diligence information you request from a seller on a deal. Paul?
That sounds good. Well, I think we'll end it there. Thanks for listening to Ask Mike Mondays. Mike, have a good day. Everyone, have a good day.